Hey everyone, in this video I'm going to bring you one growth stock that's down 83% off its high that I think you might regret it if you don't buy it on this dip here. But before I reveal what this growth stock is, I'm going to look at its financial metrics, and then towards the end of the video I'll reveal what this growth stock is. So let's get started on looking at the revenue growth for this company. And looking at this, you could see from 2019 until its most recent update, revenue has exploded, going from 150 million in a quarter all the way up to 661 million in its most recent update. Fortunately, this company has a strong tailwind behind it that's likely to support growth for the next, I don't know, 5, 10, 15, maybe even 20 years, depending on how quickly it grows. If it grows slower, then the growth is likely to be longer lasting. If it grows faster, then the growth might not be as long lasting in terms of the rapid rate of growth. It might settle down into its equilibrium rate of growth quicker if it reaches that scale faster. It all depends on the transition of right now. Most of its industry is conducted in person, but the trend is for these services to move online, to move digital. And so it's just a matter of time before this continued transition accelerates and gains more steam, and this company will benefit from that trend. The next thing I wanted to highlight is, even though the company is growing rapidly, it's doing so sustainably by generating strong cash flows. And if you look at this metric here, the cash flow from operations to sales over the trailing 12 months, you could see it growing very nicely. It used to be between 10 and 15% for a few years, and then the pandemic boosted this company's cash flow from operations to sales, and now it's comfortably above double digits and close to 21% in its most recent update. So very nice here that it's generating cash flow from operations already at this scale when its growth has a lot more room to go. Imagine what the growth could turn the cash flow from operations into as it scales into a bigger size. Finally, I wanted to point out the valuation. This stock is relatively inexpensive, trading at a forward price to earnings of just 19.3. If you look at the valuation going back to around January of 2022, this is about as cheap as you've been able to buy this stock. This is about as cheap as you've been able to buy this stock. So for all those reasons, I think you might regret not buying this growth stock here. What is the growth stock's name? It is DocuSign. DocuSign, the electronic signature company. And like I mentioned earlier, most of this industry is still done in person, signing documents in person. That feels primitive right now, that we're still getting together in person, reading over 15 pages at sometimes, signing these documents. These documents need to be stored and kept and all of these things. Now, eventually that's going to turn into digital. Now, not all of it will be digital. I'm not saying 100% of this industry will go digital. There is some, for regulatory reasons, for safety reasons, some of it will still be, in person, in physical documents. But certainly a bigger percentage of documents will be signed digitally over the next 2 decades. So that huge tailwind is a benefit for DocuSign, and its relatively inexpensive valuation, considering it's already generating strong cash flows, makes it a growth stock that I think you might regret not buying at this dip here. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.